Hi, everyone. We've got 1:01 p.m. Eastern Time right now, so we're just going to give it a minute or two before we get started as some folks continue to dial in. So just hang in there. Thanks. All right, folks, we've got just a couple minutes after 1 Eastern Time, so we're going to get started. Thank you all, everyone, for joining this webinar conducted by the Retirement Advisor University and sponsored by the MassMutual Home Office. I'm John Quirk from Workplace Solutions, and I'm also here with Dave Carrillo from the Melissa Pension Resource Center. Melissa, along with Workplace Solutions, which many of you still may know as Retirement Services, are separate divisions under the MassMutual umbrella, but we've come together here to co-sponsor this webinar. Our speakers today, Fred Barstein, Tom Foster, and Steph Chalk, are all retirement industry rock stars, each with great insight into where the industry is and where it's going in the new normal as we all get back to business. And with that, here's our host from the Retirement Advisor University, Tom Foster.
Thank you very much, John, and welcome to the call today, ladies and gentlemen. Just to give you a little further background on the other two panelists that join me today, between the three of us, believe it or not, we have over 100 years in the retirement business. So you have a real powerhouse coming towards you this afternoon. Steph Chalk, he's been with Fred at Charles for 10 years. Prior to that, he was a pension consultant. He owned a pension consulting firm, which he founded, and that is as defined by the SEC. He also had an RIA investment management firm. And he also was a co-author of a book on how to build a successful 401k plan advisory business. So real expert there. And then finally, we have Fred. And Fred is the founder and CEO of TRAL, the Retirement Advisor University. He's also the founder and editor of the 401k TV. He's also the founder and CEO of TPSU, which is the Plan Sponsor University. And he's also founded NAPANet, which is the official publication of the National Association of Plan Advisors, and he serves as NAPA's industry ambassador. So we've got quite a group of people here with a lot of experience, and what I'm going to try to do in a very short period of time is to sort of give you an overview of the CARES Act, and then follow that by the SECURES Act. I'll try to point out some opportunities that I see that these acts provide for you, but more importantly for your clients. And after I'm done with that, then Steph will talk about how this is really how it's affecting plan sponsors, and something from their viewpoint. And then finally, Fred will talk about this whole crisis and SECURE and CARES Act as it applies to you as advisors, and also talk about the new normal and where do we go after the industry gets back, hopefully, to a normal at some point. So let's start with the discussion of the CARES Act. Now, as you probably know, the CARES Act is very all-encompassing, and it actually has 6 titles in it. We're only going to focus on the second title, which that deals with retirement. And I picked out just some of the appropriate things that I think are useful to you as you look at this, again, the CARES Act and the opportunities. First of all, everything we're going to talk about from this point forward relative to the CARES Act and some of the new distributions that it allows really evolve around a term called the qualified individual, because in order to qualify for these distributions and loans that I'll mention, you have to be one of the following. First of all, you're an individual diagnosed with the virus SARS-CoV-2 or coronavirus disease COVID-19. Or you're an individual whose spouse or dependent is diagnosed with the disease or virus. Or third, you're an individual who experiences adverse financial consequences as a result of being quarantined, furloughed, or laid off, or having work hours reduced due to such viruses or disease, or unable to work due to lack of childcare, or due to the virus of reducing hours, or a business owned or operated by an individual due to the virus. So this is an all-encompassing term, but only those people mentioned there, and other terms that the Secretary of the Treasury might define later. But for the time being, that's what you need to focus on. Now let's talk about some of the provisions that are applicable to these qualified individuals. First of all, we have a new loan category, which I'm sure many of you have heard of. It's a coronavirus-related distribution, or a CRD. It must be to a qualified individual, as I mentioned, and it must be distributed by December 31st. Now, when they take this distribution, the plan sponsor can rely on self-certification of the participant who's requested it. The maximum loan is up to $100,000. There's no 10% penalty. There's no 20% withholding. Now, the unique thing about this distribution, it can be paid back. But in the meantime, if it is not going to be paid back, the taxes can actually be prorated over a 3-year period. Now, you could wait till the very third year and then take it all and be taxed at that point, but you can prorate it. Also, if you choose to do so, it can be recontributed, not only to the plan that it was taken from, but some other plan, as long as they allow for rollover. So that's something to think about. The next thing is they've increased the maximum loan amount from the normal 50% or 100% up to 100% or $100,000. But that is reduced by the highest loan outstanding balance for the 12-month period immediately preceding the loan. Now, there's a time constraint on this. This loan must be granted during the 100-day period starting with March 27th, because that's the date of the bill. So that actually brings us to September 23rd. So they have to request this distribution between March 27th and September 23rd. Now, the next thing is all loan payments that are be payable after March 27th and through to December 31st, they may be extended for 1 year. However, the interest will still accrue, the loans will have to be reamortized, and the 5-year rule is obviously extended. The next thing that the Act did is it suspended RMDs for 2020. And that applies both to the 2019 due by April 1st of this year and the 2020. And I think the reason for that is because when you look at the balances as of the end of last year, they're going to be much higher in most parts than they are going to be at the end of this year. So I think that they're trying to sort of equalize the abilities for people to not have to take these distributions and put them into further financial hardship. The other thing they did is they extended the tax filing deadline to July 15th, and I'm sure you're all aware of that. The only thing to be careful of there is they did not change the date for withdrawing excess contributions. That is still April 15th. So those are some of the things that have been created as a result of the CARE Act. Let me tell you some of the things that I think this creates as opportunities for you. First of all, I think there's no question that these people right now are bewildered. They're looking for every opportunity they can to make up for the losses that they've suffered. So I think financial wellness is going to be huge in this new normal, financial planning, and education. Education is going to be a key. And besides all this instability right now, there was actually a survey that MassMutual did back in 2015. And here are some of the numbers that I was looking up. 34% back then knew little or nothing about employer benefits. Think about that. 37% said that managing their personal finances are very difficult. 42% are clueless as to whether or not they're on track to retire comfortably. And 40% say personal finances are a distraction at work. Now think about it. That was before the Tax Job and Jobs Act. It's also before the Secure Act and the CARES Act. So think about that. So people are saying to me in today's environment, Tom, these things are driving me nuts. What do I do? Where do I turn to? Well, that person to turn to is you, because I tell them, talk to a professional who understands all facets of retirement planning and financial planning. And that, my friends, is you. And I think you are in a unique position because you understand all facets of financial planning and retirement planning. And you are positioned, think about it, you are uniquely positioned to talk about life insurance and how that plays into this new normal, annuities, disability, long-term care, and that's all increasing your lateral. But forget about lateral for the minute, forget about commissions. Really, your main goal here is a driving principle that you should all go under, and that is to help people secure their future and provide a legacy and protection for their loved one. So I think this is something that is really, we can all take advantage of. But again, not advantage, but help people understand it and work with it effectively. Now, as far as some of the opportunities that created Workplace Solutions, the one book that I would encourage you to all take a look at, and if you don't have it, we'll make sure John and David gets this to you. You have a program called the Sales Success Playbook. John just sent that to me yesterday, and that contains all sorts of useful information about such products and tools as Map My Finances, Viability, Emergency Funds, Student Loan, Planisphere, which is a prospecting opportunity for you, and also how to create a value proposition. So you are definitely uniquely positioned to take advantage of some of these opportunities and some of these misgivings that people have now relative to what do I do and where do I turn. So think about that. Also, you have some great pieces on the Secure Act and the CARES Act. You've got blogs. I know that Bob Carroll recently did a blog specifically on financial wellness. And the other thing that I see has become very popular, and I think you should at least think about it, if you do have any clients who are currently looking to take a distribution because of COVID-19, several advisors that we've talked to in the course of our discussions over the last couple of months is they actually go to an employer and say, before any distributions are made pursuant to the COVID-19 virus, I would suggest that you have these people talk to me first, because that way, before they get in over their head and take a distribution that might further exacerbate their problem in terms of having enough money for a secure future, you can show them some of these ancillary benefits, show them where they should go first before affecting their accumulation in their existing plan. So I think this is set up for great opportunities for you in helping people definitely secure their future and provide for the loved ones. I think plan design is going to be very important, and investment choices. And I think for people who understand, especially high net worth people, that they need to put away more money now because of some of the consequences they've suffered as a result of this, well, there's a great opportunity for cash balance plans. As a matter of fact, on June 17th, MassMutual will be doing a program specifically on cash balance plans. Also, a lot of people are thinking about running out of money. What am I going to do when this money runs out? So another option that I think you'll see that's available or could become available is lifetime income options. And we'll talk about that as it applies to the Secure Act. So let's talk a little bit about the Secure Act and some of the opportunities that that creates. First of all, what I'm going to do is, as I go through this discussion, I'm going to do them in order of when these things become effective. Now, the first thing is the provisions that have become effective immediately. And the first thing we talk about here is the required beginning distribution for mandatory distributions. As you probably know and you've heard, they have now changed that distribution requirement from 70.5 to 72. It's about time that they actually rounded it to a whole number. And that for participants who turned 70.5 prior to January 1, 2020, well, they remain subject to the old rules. So that's the first thing that they've done. The next thing that they've done is they've modified the distribution rules for designated beneficiaries. And I think this is a huge, huge opportunity for you to bring in some of your other alternatives that you can talk about relative to financial planning. And what they've done is they have changed the post-death required minimum distributions from qualified plans and IRAs, because generally now they must be distributed over a 10-year period following the death of the individual. Now, the only people that are not required to take that over a 10-year period are the following beneficiaries: the surviving spouse, minor child with the employee, someone who is disabled, chronically ill, or not more than 10 years younger than the employee. But think about it. For these and people who are planning on taking that lifetime distribution over their lifetime, that's going to be gone for many of these non-spouses. So what a perfect opportunity for you to talk to them about some of the other alternatives they can think about to save that money for a longer period of time, such as the use of trust, life insurance, and things of that nature. So think about that as we approach this bill. Now, the next thing that we look at is they're going to allow for penalty-free distributions in case of birth or adoption. Now, this is going to allow an individual to take a penalty-free distribution up to $5,000 per birth. Okay, so in other words, it's not only per birth, but it's per individual. So the husband and wife would each be able to qualify this. The distribution must be taken during a 1-year period beginning on the date on which a child or individual is born or legally adopted. So this also applies to legal adoptions. And it may be repaid. The individual can repay the amount to an eligible retirement plan which accepts rollover contributions. So again, more to talk about in terms of these new distribution options. And again, make sure before they do that, they check with you to make sure it's an appropriate distribution. The next option is, and I think this is going to be very, very appropriate for many employees who feel they're going to run out of money. Because as you know, many financial institutions allow for insurance companies allow for lifetime income products. But there's always been a little bit of a problem with that because the employer has been worried about, well, if I choose that as an option under my plan and something goes wrong relative to the company from which I've taken that money, then I'm on the hook from a fiduciary standpoint. But what this bill has done is it's created a new fiduciary safe harbor. And what this does is it allows a plan sponsor's selection of a lifetime income provider for a defined contribution plan with safe harbor. And this is what must happen. The fiduciary must conduct an objective and thorough and analytical search. They must consider the financial capability of the insurer and the cost in relationship to the benefit and the product features of the contract and the administrative services to provide that will be provided. The fiduciary must obtain written representation from the insurer that they are licensed to do business at the time of selection in the preceding 7 years, operates under proper certificates of authority from insurance commissioner, filed audits of financial statements, and maintains appropriate reserves that and net operating under the supervision and rehabilitation or liquidation. And finally, undergoes a financial exam by the insurance commissioner at least every 5 years. So that now sort of opens the door to start more discussions about an income product within a qualified plan. So another opportunity for you. The next option we have here is they increase the penalties for late filings for different forms like the 5,500 and tax on withholding notices. Because obviously by allowing all these types of distributions and exemptions under both the CARES Act and the Secure Act, the government has to get their money from somewhere. So this is a way to make up for some of those deficiencies. Okay, the next thing we have is these are for due dates after December 31st, 2019. And so the first one is it increases the cap for automatic enrollment safe harbor. Now, what does that mean? As you probably know, there are several types of safe harbor. You have a traditional safe harbor and you have the automatic enrollment safe harbor. If you're using an automatic enrollment safe harbor, then as you know, the employer will take money from the employee's paycheck, and typically they'll start at 3% in the first year and increase it by 1% for every year thereafter. And that caps out their ability to have to contribute at 6%, but in the past, they could keep that going until 10%. So even though they weren't required necessarily to match it, they could still provide for the employee security by going an additional 4% up to 10. That 10% has now been increased to 15%, giving more attractiveness to these types of plans. Also, they've changed the rules related to safe harbor, non-elective contributions. Now, if you take a look at the safe harbor, the traditional safe harbor, there's two types. There's a matching safe harbor and there's a non-elective safe harbor. This, what I'm about to tell you, only applies to the non-elective safe harbor. So all the other rules you're familiar with in terms of setting the plan up and giving notices, that still applies. But in the case of the non-elective safe harbor, there's no longer required to give notice. And also, they can now change and set up their plan right up until the 31st day of the end of the year. And also, if they can even wait until the end of the next year, but if they do so, they have to increase the percentage that they're required to contribute from 3% up to 4%. So again, an interesting opportunity to talk about those plans that you currently deal with that have safe harbor. The next thing we have, and this is where I think this is an area that you should really concentrate on. And what this is, it increases small employer plan credits. Now, I think the small business market right now is low-hanging fruit and something you should all be focusing on. Listen to some of these statistics. 99.9%, think about that, 99.9% of all employer plans in this country are small businesses. And the small business by the IRS is defined as less than $10 million in assets. The Small Business Association defines it as 500 or less employees. And most of these things will play out the Small Business Association definition as opposed to the IRS definition. And think about this, 99.9% are employers that are considered small businesses, but 36% have no retirement plan whatsoever. The reason for that, in some of the surveys that were done, it's too expensive. And another reason why they did have a plan was because they wanted to help people save for retirement. So think about that. We have to find out the way to balance our equities. And one of the ways to reduce costs, or at least talk about savings, is this new small business retirement plan credit. Now, let me tell you what this says, and then I'll give you a very quick example of how it works. The credit is going to be changed to the greater of 500 or the lesser of 250 of each employee of eligible employer who is non-highly compensated, and they must have at least one non-highly compensated employee who is eligible to participate in a plan, or $500,000. Think about that. Sounds rather confusing. Let me give you an example. Let's say that you have $2,000 in plan costs. Well, the first thing you're going to do in this equation is take 1/2 of that. So that's $1,000. So set that over to the side. Now what you're going to do is you're going to apply the second part of the equation. Let's say I have 300. Let's say I have 3 employees. I'm multiplying 3 employees times 250. That's 750. Well, even though I would be eligible for $1,000, because I only have 3 employees, I would be limited to a credit of 750. Now, if I had 4 employees, then I would be eligible for the full 1,000 because 4 times 250 gives me 1,000. If I had 5 employees, then I'd be at 1,250, but again, I'd be limited to 1/2 of my cost, which would be $1,000. So I hope that's helpful. A little confusing, but once you understand it, it's a nice thing to talk to plan sponsors about, especially if they're thinking about starting a plan for the first time. In addition to that, if a plan is set up and use automatic enrollment, so that would be any plan with employee deferrals, where there be salary deferrals involved. So that would not only be qualified plans, but that would also be a simple IRA. And if they do that, then they receive an additional $500 credit for each of the first 3 years. So that's, again, something to think about. Now, besides that, there's also a tax credit for individuals. And that is primarily for low to moderate income people. As a matter of fact, in order to get the full credit, the maximum is $1,000 or 50% of your deferral. And that starts at $39,000 for married filing jointly. Below that, you get the entire 50% with a maximum of $1,000 if you're married, $2,000. Once you go over that, then it's pro-ratally decline. Another thing to definitely focus on, as I mentioned, 99.9% of these small employers make up again, 99% of all businesses. Well, 95% of those are pass-through organizations. So that would be like a sub-S, a proprietorship, sole proprietorship, and things of that nature. But don't forget about the 199A tax, which allows these pass-through organizations to get a 20% credit on their tax return as a result of tax 199A. And the income levels for that are 163 to 213. They would get below 163, they get the full 20%. Between 163 and 213, they get a portion. Married filing jointly would be 326.6 up to 426.6. Below 326, they get the full 20. Over that, they would get a pro rata share. So something to think about, because this is something you're going to be dealing with, because this opportunity to talk to small business, I think, is a great, great opportunity. Okay, the next change is the portability of lifetime income. This was another drawback to the lifetime income products, because under here, what would happen is if the plan no longer offered a lifetime investment, then the employee was sort of stuck. What do I do with it? Well, now it does allow for rollovers of the lifetime income product. So again, something to focus on for those people who are looking at that. Another thing they've done here is they've changed the timing for plan adoption. Now the adoption can be made right up until your tax filing deadline plus extensions. There are some exceptions, but this really is beneficial, because oftentimes an employer does not know that they need a plan until after they've sit down and filed their tax return with their accountant, and that's typically after the end of the year. So a nice change there. Also, we have some delayed effective dates. Now this expands, and this is going to be another big opportunity for you, especially in that small case market. Think of the numbers that I gave you, and that's going to be the use of MEPs. And the MEP is a multiple employer plan. It is now going to allow people that do not have a nexus. Before, remember, they had to be of the same industry. Now they can be of different industries. So they've eliminated that requirement. And also, they've eliminated the bad apple rule. And what that means is that if one of the plans within that organization, within that structure, didn't follow and conform to the rules, then that would affect the entire group. Well, that has been eliminated as well. So we don't have a lot of time to get into it, but I think the MEPs, which are now called PEPs, pooled employer plans, are going to be a big opportunity for you to talk about to small business owners. Okay, the next thing we have is, and I think this is a big one, and that is requires lifetime income disclosure. As you probably know, one of the disadvantages of people who are in a plan is they typically receive a balance, and it says you have X amount of dollars in your plan as of the end of the year. What they don't understand is, well, what does that dollar amount mean to me in terms of lifetime income over my life expectancy? So now there will be a requirement that at least every 12 months you'll have to show what that will look like in terms of an annuitized payment. And there are certain restrictions that the DOL is looking at right now, certain models and things of that nature, and that doesn't come into effect until later on in the year 2021. So at least there's time to plan for it. And then finally, the last change is it's going to allow for long-term part-time employees to participate, because in the past, normal requirements were age 21 and 1,000 hours of service. Now, if you have part-time employees who work at least 500 hours in 3 consecutive years, starting after 2021, they will be able to be included in the plan, and they will be excluded from having to have employers make matching contribution. They can also be excluded from testing. So I think there's some great opportunities under here. As I said, as far as you're working with the Workplace Solutions Group, I think this is something that you should all be thinking about. Work with your local wholesalers, both retirement and workplace solutions wholesalers. Also offer seminars for employers, even if they don't have the plan, with the opportunity of potentially getting their plan. Offer to speak at local chambers and SHRM meetings, and look at your existing book of business. Work with the wholesalers in your area. You can use Planisphere, which is a prospecting tool, but I think the world is your oyster. And just to show you some of the other opportunities, I'm now going to turn it over to Steph, and Steph's going to talk about what this new norm looks like in terms of the plan sponsor. So Steph, I'm turning it over to you, and talk to us about what we need to know relative to working with plan sponsors.
Thank you, Tom. And I would also like to extend my thank you and appreciation to all of the advisors who are on the call. I know time is your inventory, and we want to make the best use of your time, so we're going to get right to it. First thing you need to realize right now from a plan sponsor's perspective is they're not all acting and functioning as plan sponsors today. That's not top of mind. It's not their sole concern. Today, they're business owners, they're executives, and they're senior managers who are overseeing a business that is experiencing times like we've never seen before. So a lot of them are taking a look and saying, what business are we in? And whether that is a restaurant, movie theater, or whatever it is that they're selling or whatever they're producing, are we still permitted, or are we still able to provide that business that we've traditionally been in? I think the second thing they're looking at is, what does our cash flow look like? And that's a very difficult concept for people to be forced into looking at. I mean, a lot of people in companies, the treasurer, the controllers, et cetera, they always look at that. But now more and more people who have been traditionally serving in a plan sponsor role and on the executive committee of the retirement plan or the benefits committee, they're all looking at cash flow as well. So that's probably a very high point on what they're looking at. And then third, the thing they're looking at is, do we really need to pivot to another product line, or do we need to pivot to another service from what we've delivered in the past? So that is going to be, that might be determining their survival or not. So as you can see, the issues are much greater than the last quarter performance in equities or in fixed income. Their issues are macro issues and critical issues for their company. They're also dealing with a workforce, and what does their workforce look like? And we all need to remember that the entire workforce, in many cases, they are all plan participants as well. And Tom's mentioned a number of good points from the Secures Act as well as the CARES Act. And going forward, how do we work with that? And the new decision that the employers are working with is, how do we run with our existing staff, or do we maintain our existing staff as we run? So the decision process then brings into thought, do we furlough? Do we lay people off? Do we adjust the hours? Do we adjust the functions that our staff is performing? Et cetera, goes down the line. But protection of the clients is the primary concern right now for what we would call the traditional plan sponsors and the business owners. So they want to keep the clients they have if they're able to continue to provide services. The employer also wants to protect their staff. So these organizations who are still operating and still functioning have been forced into either permitting or going to a remote workforce. And that is something that's key, I think, in your position, because companies traditionally haven't gravitated to that, much less been forced into that mold or into that model. So one area where I believe you can help plan sponsors and the executive team is anything you can do them to help them become more operationally efficient, and that might be with equipment or connections, become more functional in what they do, whether that's technology, programs, apps, and I know MassMutual has a lot of technology around that, where you may be able to provide dashboard type information for executives in a firm. And again, this is all before we really drill down and get into retirement. So everything I've talked about before now has been not really retirement focused, because plan sponsors aren't that concerned with the retirement plan as of today. Questions the employers are being asked are around taking distributions from plans, taking loans from retirement plans, changing deferrals, possibly suspending the deferrals altogether. So think of these things that the plan sponsor is going through and how you can help them in working through those issues. And they are absolutely struggling with this. I spoke with a few plan sponsors in anticipation of this call just to get an idea of what's going through their mind. And they're being bombarded with questions on distributions and loans. So the more you can become a specialist in what's going on with regard to loans and distributions and deferrals, the better you are positioned. And I would say also think about going outside of your own book of business. And there may be a lot of people who you can help, a lot of plan sponsors you can help, who you don't have as clients right now. But this may be the avenue that separates you, that distinguishes you from who they might be using currently. So it's a relationship business. It's all about building these relationships. And there's really no better time to build a relationship than right now. You also need to be concerned with, or you need to be respectful of time and effort and who you can access in a company, because you're not going to call someone and really excite them about loans and distributions unless you're talking to the right person in that organization, that right person who you can help and who is also not being properly serviced by their existing advisor. So as Tom had indicated, a lot of the topics that we're talking about can be included in the summary plan description. What can and cannot be done can probably be drawn out of a summary plan description, but you may have to go into plan design in order to find that. And I would use the resources available to you in your organization to make that happen. I would say this recent incident that we're in is a real harbinger of the need for financial wellness. And financial wellness, debt management, and maintaining a cash position, or the concept of liquidity, those are all things that hit home back in 2008 during the real estate crisis. But those are issues. Unfortunately, the American investor has a very short memory, and they kind of got out of the mode of thinking about planning not only for their retirement tomorrow, but for day-to-day tomorrow as well. So this situation has, if nothing else, it has forced participants and employees and companies to realize the importance of maintaining a liquid position and being financially well. So those components, financial wellness, maintaining some kind of a cash position, those are all the foundation for a successful self-funded retirement plan. And I would also recommend that you, as Tom had mentioned, get involved with SHRM, Financial Executives International, any of these groups that support those individuals who are traditionally plan sponsors within an association and decision makers on the plan. That will serve you well as well. So with that, I will turn it over to Fred Barsky.
Yeah, well, before we go to Fred, Steph, what I thought we'd like to do is we're going to throw up a couple polls that we would like you to respond to. So the first thing is, if you wouldn't mind, DJ, let's put up our first poll. Okay, what % of your revenue comes from corporate retirement plans like 401ks and SEPs? So I'll give you a chance to fill that out. And while we're waiting for the results, David, do you have any questions from the audience that have come in via the chat?
Yeah, thank you, Tom. So the first one I have is, can PPP loan money be used for an employer match in a plan? If so, can the employer use it for his or her own match, even if that is above the $100,000 per person cap?
Yeah, well, that's something, David, that I would suggest that whoever the person was that asked the question, I would really check with your legal department at MassMutual to answer that question. I don't want to give an opinion that might be contrary to anything other people say. So I would suggest they talk to Eric Lieberson or his group, or Jim Viola, to answer that question appropriately. Do we have any other ones that are coming from the audience, David?
No, then the last one was more PPP related, which may be a similar response, Tom. But
Yeah.
can they use the PPP loan money for matches outside of the 8-week forgivable period for the loan?
Yeah, that again, I think, is something that should be handled by the MassMutual legal and compliance area. Well, let's look at the results of the poll. Okay, you see here the result of the poll is for most of you, the retirement doesn't make up a large part of your practice. Well, I think hopefully what you've seen today, especially in the small business area, gives you more food for thought, especially when you realize you don't have to be the expert in a lot of these things. That's why you have your wholesalers on the retirement side as well as on the workplace solution side. So that's not surprising me. Let's take a look at our next poll, and then we'll come back to you, David. Okay, select one of the following. My primary reason for getting corporate retirement plans is to sell ancillary business. Yes or no? Okay, while we're waiting for that, any additional questions you have there, David?
At this time, Tom, we have no more additional questions.
Okay, and one thing I wanted to stress that Steph mentioned as part of his discussion was these amendments don't have to be actually made until the end of 2022. And if it's when you're dealing with corporate and with nonprofits and things of that nature, it's actually extended through to 2024. So, but it's very important that you, from plan design and plan review, you talk about these things because they can implement them immediately, but the formal plan amendment does not have to take place until later on in 2022. So make sure you're aware of that. Okay, so let's look at the results of the poll. Okay, as you see here, which is something I thought would be the case, the majority of you sell retirement plans as a way to get ancillary business. And I think you'll see today, or hopefully you'll see today, that should definitely be something that will spur you to do even more, not only on the ancillary business, but also in the retirement plan business as well. And as I said, you've got a great group of people to work with in your workplace solution group. Okay, now I'm going to turn it over to Fred Barnstein, and Fred's going to talk to us about what it looks like from an advisor's standpoint, and also what is the new normal going to look like. So Fred, I'll turn it over to you to give us some of your words of wisdom. Fred?
I was put on mute involuntarily, so I just got off that. So
Okay.
I was wondering if my wife was on the controls, because she would
Right.
like. So thank you, and thank you to MassMutual for sponsoring this, and also to David and his group for allowing us to present. So the first thing I really want to emphasize, there's a great quote. It says, "A crisis is a terrible thing to waste." And I think it's really, really true in the case here. I think that post-crisis, you're going to see a dramatic market share shift, probably the largest in the DC history of plans moving to advisors that are really knowledgeable and can help, not just specifically being ERISA specialists, but really have a holistic approach. Because what we're seeing here now is that retirement, and we've seen it a little bit, but it's going to get accelerated, it's the convergence of wealth, retirement, and benefits. And, you know, I think that up until 2 or 3 years ago, most retirement plan specialists, those people that really focused on this DC marketplace, they really didn't do much wealth management or IRA. Part of that was the DOL's fiduciary rule really muddying the waters, and people weren't really understanding what they could and couldn't do. That has totally changed. And so we're seeing advisors really, really focused on wealth management. I think those advisors that also have a benefits background and can understand that, which is a much smaller percentage of the retirement advisors that have a wealth management focus, they're at a tremendous advantage, because what people are talking about, it's not just about the retirement plan, it's the holistic, how do I help my employees? How does retirement integrate with all of the benefits that we're seeing? So that's what advisors that I think are successful, and they're trying to and making themselves be very knowledgeable about the payroll protection program and the emergency, the EIDL, I forget what it, emergency investment program, helping plan sponsors to figure and navigate their way. My wife is our chief administrative officer, and she was able to secure the PPP loan for us. And she's on a webinar literally every single day with the SBA and what those requirements for answering those questions. That we brought up, you know, our opinion, this is not a legal opinion, is that any payroll, gross payroll can be used, and benefits can be used to offset the PPP loan. But again, that's not a legal official opinion, but that's the position that we're taking on this. So that's what we're seeing advisors. New sales at this point is not going out to prospects other than people that might have been very, very close. But the focus for plan sponsors these days is not to change their record keeper, change their funds, change their advisor. You know, they're dealing with so many other things. The new sales today is keeping your current clients and having continuous conversations with your plan sponsor. Certainly, you know, we're seeing some of the specialists that we talk to at least once a week reaching out, over communicating. One of the questions we had on a webinar we were doing with another advisor group was, okay, how do I create an education, advice, guidance, communication program with employees during the crisis? And the answer to that is, if you haven't done that already, you're not going to do it during the crisis. But the advisors who had already positioned themselves and had a program, and what we've seen with advisors who have done this, they're using Zoom and GoToMeeting, and they're finding that participants, employees, are much more comfortable doing that because they're doing it after hours. They can get their materials together, and then their spouses are involved. So we think that if you have a regular communication, you know, with employees, a program to leverage that and leverage the technology that's there. And if you don't, good lesson to learn to build that, because this is not going to be the last crisis in our lifetime on it. And I think that the MassMutual advisors and advisors that are affiliated with insurance, they're used to dealing with and selling ancillary business, as we saw in the poll, that ancillary business is just part of what they do, and they're very comfortable, as Tom said, with life and disability and annuity, and looking at, from a plan sponsor's point of view, you know, what are the benefits that I'm offering holistically, and then from the individual participant's point of view, what are the things that I can do, that you can do to help them overall with financial planning. Most wealth management advisors are looking for larger rollovers. I know that, you know, Cap Trust, as an example, which does a lot of wealth management, their minimum wealth management client is at $1 million. And I think that, you know, that's a very small percentage. And if we can help a greater percentage by offering multiple services, I think that's what we're seeing is those advisors who are used to that, comfortable with that, have programs, have ancillary, those are very, very helpful. And I think also finally, in terms of like what's happening right now, is advisors that are affiliated with larger organizations that have resources like webinars and tools, especially around the SBA programs and the government programs, reaching out, not as a prospecting overtly, but reaching out to every potential company or prospect in your area, inviting to these webinars, sharing these. And I'll share an example, a story. One of the advisors that does TPSU for us and actually used to be a MassMutual agent, he had met a plan sponsor at one of the programs and was dripping on them and was sending them, webinars and materials. And the CFO, decided to sign up with this advisor, but he said, this advisor, we don't even pay him, and he's giving us all this great information, and our current advisor is not. And that's, I think, sort of the negative side, is that those advisors that maybe are not reaching out to their current plan sponsor clients and corporate clients because they're focused on other things, they're going to be very, very vulnerable when this crisis comes back or the crisis is over and we're coming back to a new normal. But with that, I wanted to then just pivot to, what do I think the new normal is going to look like? And I think that the convergence of retirement, wealth, and benefits is going to be significantly accelerated. I think a lot of the trends that we started seeing, like the convergence and financial wellness, things like that, and the changing in fee structures, all of these things are going to get accelerated after the crisis. And so what we're seeing is that the defined contribution platform, the workplace platform, with the integration of benefits where possible, it's more than just saving for retirement. It's student loan debt repayment, where they're using that as a way for millennials that could not afford to contribute and were to their plan and were missing out on the match. They're using, if you contribute to your student loans, you can take advantage of the match. The emergency savings vehicle, which is a perfect sidecar to defined contribution, and MassMutual actually just announced the availability of that emergency savings sidecar in January with Millennium Trust. That is going to be a huge. Plan sponsors hate loans, but they also are reluctant not to offer it because they think that it will scare off people contributing to the plan. The emergency savings, and maybe have money go into that first before it even goes into retirement, I think is going to get accelerated, and be ahead of the curve on that and be advocating. I think there's only 2 record keepers, including MassMutual, that currently offer that. I think the new normal is accelerated. We had been focused on the participant. That's going to get hugely accelerated. If you are helping employees like you normally do with your financial wellness and the life disability annuity, you are much, much more attractive to plan sponsors because the triple F advisor, the advisor who only focuses on fees, funds, and fiduciary, only deals with the C-suite, they have been commoditized, and they are going to continue to be commoditized, and it's going to be very, very hard to command the fees and to differentiate yourself. Those participants not only make you more attractive and working with the participants, but it's a way for you to monetize. I think technology, I think the crisis is going to make a lot of the technology that we've had in the last 10 years that has not resulted in increased productivity. We haven't seen increased productivity in the last 10 years like we did after the internet first came out. And I think that's going to be manifested in much, much more video conferencing. People are more comfortable with a meeting through video, and whether that's your committee, and as I had said, the participants, in working with them one-on-one, it's so much more effective, and it's actually, I think, a preferred means. I think financial wellness is going to get accelerated, but to be honest, most financial wellness has been a prospecting tool, and we haven't really seen much change in behavior as a result of the current financial wellness programs. But to me, technology is going to allow us to, combine smart data with technology, which really is a way to leverage the advisor who has a process. So it's advisor, technology, and data combined is going to be able to help us to know who to talk to, when to talk to, and what we should be talking about based on what we know about them, and just be a coach and a mentor and sending text and avatar and things like that. So we think that that is going to happen once this crisis subsides and we're starting to see glimpses of coming back. This is a time to accelerate your prospecting. And what I would focus on is not so much, I'm an advisor, I do this, I do that, is what did you do? Give examples and stories during the crisis, what you did to help your clients, and what stories and how they responded to that, whether it's the participants or the plan sponsor. So it's just a very good way to, and keep a file of everything that you're doing so that you can use that in your stories. I would leverage you're part of a great branded organization, MassMutual, leverage their capabilities. And then finally, the new norm in prospecting is content marketing and education. If you can deliver something of value, if you can educate and be a consultant and send them information and add value before you ask for the business, it's going to be a lot better, because just going out and cold calling and trying to get in front of people without having added value, which also improves your credibility to them, I think it's going to be very difficult. So I think that we're going to see a lot more education, and you have to, what we've seen is, as Steph said, we've seen plan sponsors are waking up. They are not, they've been asleep for a long time. They've gone from being unconsciously incompetent to consciously incompetent. And they're waking up, seeing the importance of retirement and how it fits in with their overall benefit structure, and they're going to continue to be smarter, but they really are demanding, and there's a real hunger out there for good content and also for education and training on that. So with that, I am going to stop, and maybe we can do our final poll question and see if we have any questions from the audience. Tom?
Yes, Fred. We're going to the poll question right now. But one point of clarification as we look at this final poll, and that is the extended amendment date that I mentioned for 2024, that applies to government plans. So for the rest of your plans, typically it's going to be the end of 2022. So as you can see here, our question is, how often do you speak with your 401k or 403 billion plan sponsor clients? And while we're doing that, David, do you have any more questions that have come in from the audience?
We do, Tom. We have a couple of questions. One of the questions was, what is the best way to find a company with no retirement plan? Okay,
Fred, would you like to handle that?
I would if I had a good answer, because usually it's 5,500 form. Right. So I'm not sure whether it's, Chamber of Commerce or I'm not sure how to do that. Steph, do you, what lists would, would you go to?
I don't know of any list per se, but obviously if you know who you want to prospect, you can always look them up on Free ERISA or look for the 5,500, but it's more a negative, almost a negative election.
I would say I just need a few minutes to think. If a company has the 5,500 also, if I'm not mistaken, has benefits and healthcare plans as well as retirement, and you can cross-reference that 5,500 form to the plans, the companies or organizations that have a benefit plan but don't have a retirement plan. I think it's more common to have the benefit than the retirement. So that might be one way to do that. I would also look for associations. We do a lot of work with associations. They help recruit plan sponsors to our TPSU program, and that might be another way to do that as well. Chambers of Commerce.
Yeah, and typically the way you look for employers that have plans would be your prospecting tool, and that is Planosphere. But I think, as both Fred and Steph has pointed out, it's difficult to find out from a media source or from any other source who does not have a plan. So I guess the best thing to do is, if you have a prospect that you want to go after, or you have an existing book of business, is just look to see if they have an existing plan, or call them and just ask right out, do you have a qualified retirement plan of any type? So I mean, that's cold calling 101. Do we have any? Let's look at the final poll and the answers to that. Okay, you see here that the majority of you are, well, it's pretty much tied between quarterly and semi-annually, because as Fred said, I think the key to this, if you do have existing 401k and retirement plan clients, the key is constant communication, keeping up to date on things that are happening in the industry, and continue to show them how you can help them in this time of crisis. And also, as Fred said, which I think is a great idea, is that when you do go prospecting for new business and you have kept in touch with your existing clients, talk about that. People love stories. They love to hear stories that are people that are similarly situated as themselves. And I think that's a great way for you to endear yourself to not only your existing clients, but also new clients. So David, any other questions before I turn it back over to John?
No, I think I'll close it out here, Tom. Thank you so much.
Okay.
So Tom, again, thank you for the time this afternoon. So as we all know, over the past couple of months, certainly we've all learned just how quickly we can adapt and have to adapt as a society. Within days, our industry became a work from home environment. And like all of us, our clients have had to adjust very similarly to that, to the fundamental and significant changes in their businesses as well. As an example, Zoom basically overnight went from 10 million users to over 200 million users. You know, meetings that we have had historically face-to-face are obviously now being conducted in a virtual environment. And in many ways, our days are fuller than ever. So we appreciate the time that you had provided us today. We hope you found today's session beneficial and informative, with specific items to maintain and grow your retirement plan practice as we continue to identify and learn what our new normal might look like. So we hope we gave you some insight into that. I want to extend a special note of thanks to John Quirk and the entire team at Workplace Solutions, Fred, Steph, and Tom from the Retirement Advisory University. And most importantly, I want to extend a thank you to our MassMutual financial professionals and your teams for everything that you do for your plan sponsor and plan participant clients. Thank you for your time today. Take care, everybody, and be well.